So now I want to go on to chapter 9. So chapter 9 deals with standard costing. Okay. For each under standard costing, we have 2 standards that have to be developed for each product cost. We have direct materials, direct labor, variable overhead, and fixed overhead. So we need to have 2 standards for each of those 4 product costs. The first one is the standard price. The standard price is how much we should pay for 1 unit of input. So if we're talking about direct labor hours, it's how much we should spend for 1 direct labor hour. If we were talking about making shirts, the input, the raw material or direct material input would be fabric. So it would be how much should we pay for 1 yard of fabric. Okay. The other standard is a quantity standard. I refer to it as a usage standard. So if we were talking about direct labor hours, how many direct labor hours or what portion of a direct labor hour does it take to make 1 shirt? For materials, how much of the fabric does it take to make 1 shirt? Half a yard, 3/4 of a yard, an entire yard. So it's how much of the input you should use, which is why I call this a usage standard. Then the standard price times the standard usage gives you standard cost. So we have a standard cost for each of the 4 product costs: direct materials, direct labor, variable overhead, and fixed overhead. Now, how do I establish a standard? So for the quantity or usage variance, we'll use historical experience, engineering studies, input from operating personnel. For the price standard, you have to work with the purchasing department, the personnel or human resources department, and operations. So if we were talking about how much we're paying for the fabric, we would look at what type of fabrics, what are the specifications that operations would give you for what type of fabric? Is it silk? Is it cotton? Is it linen? Purchasing department, how much can they purchase it at? And if we were talking about labor, we would get the personnel and human resources involved, along with operations. How many hours portion of an hour we're going to use to sew that particular shirt? What do they get paid per hour? Here you're looking at market forces, trade unions, and other external forces. So if you have a union that specifies how much you must pay each type of worker, then the standard rate for labor is already given to you. You're also looking at market forces. Sometimes you have to pay more than you want because that is the only type of worker you can get. So you might have to hire a more skilled worker than you had planned on, so you're paying them more, or supply and demand of the workforce. When there are fewer people available, the price will go up. You're going to have to pay more to get the workers to come work for you. Okay. So We have ideal standards, which is maximum efficiency. Perfect world. They're only achieved if everything operates perfectly. From a perspective of influencing your employees to try and meet the standards, the behavioral perspective, you don't want ideal standards. If your employees feel that they can never achieve it, they're not even going to try to achieve it. Okay? You have currently attainable standards. Can be achieved under efficient operating conditions. This allows for normal breakdowns, interruptions because you're doing maintenance on machines or because you were waiting to get the delivery of fabric, and a less than a perfect skill. Okay, so from a behavioral perspective, currently attainable standards are what you want to use. All right. Then you have Kaizen standards, continuous improvement. So you would start with currently attainable, and then you would look at how can I reduce the time? How can I reduce the amount of fabric or reduce the amount of scrap or things that aren't passing quality? So it would focus on cost reduction. This is covered in Chapter 12, which we are not covering in this course. So if you're using activity-based costing, your standards for, or normal costing, your standards for your overhead cost, variable overhead and fixed overhead, your standard rate, typically the term rate is used for labor and overhead. Your rate is the predetermined overhead rate. Okay. You can use standard consumption patterns. We did some consumption ratios in Chapter 7. Okay. All activities are classified as either value added or non-value added. Okay, so we want to use a standard cost system for planning and control purposes. The definition of a standard is the budget for one unit of product. A standard is the budget for one unit of product. So that's our planning purposes. Then we're going to compare actual to what we planned as the standard. For product costing, we're going to be carrying our inventory of finished goods at standard. Okay. So under actual costing system, all three product costs are actual. Normal costing, you have actual materials and labor, budgeted overhead. Under a standard cost system, materials, labor, and overhead are all at standard cost per unit. Okay. So the budget typically is for all costs incurred. A standard is the budget for one unit of product. So we have a standard cost sheet. Here we are making yogurt, frozen yogurt. You have multiple material inputs. You have only one type of direct labor, which is machine operators. You have variable overhead and fixed overhead. So in doing these, we are looking at the standard cost per unit, which is the standard price for that particular input times the usage of that particular input gives you the standard cost. So it should cost us $2.40 to make 1 quart of yogurt. I think the container is in a quart. Okay. Notice these other inputs are in ounces. This doesn't specify, but it is a quart. Okay. So this is your total budget variance. Actual cost incurred minus standard costs allowed. SP times SQ is standard cost allowed. To calculate our product variances, we need 4 variables. Actual price paid per unit of cost factor, not per unit of product, but per unit of cost factor. So this is per yard, per gallon, per ounce, per board foot, whatever your input for materials is. Okay. Actual labor rate. We're talking about labor. Actual quantity of direct materials used. Standard price, SP, standard quantity allowed. For most problems, this has to be calculated. The formula for SQ is standard usage per unit times actual units produced. Okay, so for the variable product costs, direct materials, direct labor, variable overhead, we are going to be using these 4 variables to calculate the variances. This is the total variance. Then the total variance can be split between a price or rate variance or a usage efficiency. Price is the term used for materials. Usage is used for materials or quantity. Rate is used for labor and overhead. Efficiency is used for labor and overhead. So the price rate variance explains how much of the total is due to prices paid for the inputs. It explains how much of the total variance is due to the prices paid for the inputs. For the usage or efficiency variance, how much of that total variance is due to the usage of the input, or how efficiently we are using that input. Okay, so F stands for favorable. So when actual is greater than standard, then it's a favorable variance. Actual less than standard, it's favorable. When actual is greater than standard, it is unfavorable. Okay? So this is the way I like to work the problems. I use the second formula. Actual minus standard is in parentheses times the AQ. So how much price is responsible for what portion of that total variance? A is greater than S, it's unfavorable. When A is less than S, it's favorable. So for materials only, you can calculate the price variance, and it's for the price variance only, at 2 different points. One is when you actually purchase the material, which is the earliest point possible. And when you use AQ purchased, the variance is the price variance is the responsibility of the purchasing agent. When you use the amount that was issued to the production, That's AQ used. Then the price variance is the responsibility of the production department. Okay. Once we calculate these variances, the accountant calculates the variances, puts them on a report for management. Management then investigates to determine what caused the variances and how they can take corrective action. Okay, so this is the formula that I will be using for the price variances. Then we have the usage or efficiency variances. The term usage or quantity is used for materials. So what is in parentheses is the difference between the quantity, the actual quantity used versus the standard quantity allowed. Remember, standard quantity allowed is calculated. SQ is calculated. It is standard usage per unit of product times the actual number of products we produced. So this is how much we should have used based on actual production. This is what we did use for our actual production. If actual is greater than what we were allowed, greater than standard, then the variance is going to be unfavorable. If it is actual is less than standard, then it is a favorable variance. Okay. So here's an example of the direct materials price and materials usage variances. We're looking at how much should have been used for the actual production for the month of April. We're going to calculate materials price variance and the materials usage variance. M stands for materials. Okay. So standard quantity allowed, SQ, is the standard quantity per unit of 25 ounces. Actual production was 30,000 units. So our SQ is 750,000 ounces. The actual price paid was 5 cents per ounce. The standard from that standard cost sheet was 4 cents per ounce times the AQ used of 750,000 ounces gives us, first of all, unfavorable because 5 is greater than 4. The dollar amount of the unfavorable variance is 7,450 unfavorable. Okay. The materials usage variance. 745,000 is what we actually used. Our SQ was 750,000. We used less than we were allowed. Actual was less than the standard, multiplied by the standard price of 4 cents gives us a $200 favorable variance. So the total variance would be unfavorable, and the total variance would be 7,250 unfavorable. This is another way of doing the variances. AQ times AP, actual cost incurred. SQ times SP is standard cost allowed. So we paid $37,250. We should have spent $30,000. So the total variance was $7,250. How much of that was due to prices? How much was due to the usage? Most of it was an unfavorable variance from prices paid, and some of it was we reduced the unfavorable because we had a favorable usage variance. So management is going to go and investigate, why did we spend a penny more per ounce for our raw material, our direct material, our inputs? Was there a way to correct what was paid? If there was, how can we correct it? Now, sometimes if there's a shortage of your input, you're going to have to pay what the market demands. That's why we said market conditions. But it may be that you tried out a new user, a new supplier of the product. They charged more, so that's why it was unfavorable. Was it worth it to use the new supplier and pay a little bit more? No, because of that unfavorable variance, if we had a choice on it. Okay, so total variance, 7,250 unfavorable. This was the bill of materials. So our output was 30,000 quarts. This is what we should have used for all of these inputs. So 10 ounces times 30,000 gives us 300,000 ounces. 8 ounces times 30,000 gave us the 240. 4 ounces times the 30,000 quarts gives us 120. 1 ounce per quart times 30 quarts is 30 ounces. And then we had 30 containers. Okay. So how do we journalize the variances? So we're talking only about two right here, direct materials price and usage. Direct materials was unfavorable. So you debit an unfavorable variance that increases cost above standard. So you're going to debit a variance that is unfavorable. You're going to credit a variance that is favorable. So here's the journal entry. Unfavorable materials price. We are carrying materials at standard cost, standard price. So we're debiting materials for the standard price times how much we purchased. We are debiting direct materials price variance, the unfavorable for 7,500, I believe it was. And then we're crediting accounts payable at actual cost. So unfavorable variances are debited. They are increasing the cost when we get to the income statement. Then for the usage variance, we debit work in process at standard price for what we should have used. Okay. We credit the materials cost for how much we actually used times the standard price, take it off at the amount it was put on. We had a favorable usage variance, so we are debiting. Usage was unfavorable. I thought it was favorable. Oh, they're assuming it's unfavorable. Okay. Ours was a favorable, so we would have credited the usage variance because it was favorable. Here they're assuming that it's going to be unfavorable. Okay, so you're carrying your inventory at standard. Then we have direct labor variances. We have direct labor rate variance, and we have a direct labor efficiency variance. Again, we have the 4 variables. This time, R's are used for prices and H is used for hours. So actual rate, standard rate, actual hours, standard hours. This is the formula for the rate variance. Actual rate minus standard rate times actual hours worked. The efficiency variance, actual hours minus standard hours times the standard rate. Okay. So calculating, actual production was 30,000 units. Actual hours were 325 hours. Actual labor rate was $15.90 per hour. Okay. So standard usage of hours, SQ, standard H, standard hours, is the 30,000 quarts times the standard usage per unit. Okay, standard usage per unit was 0.01 hours. So in producing the 30,000 quarts, we should have used 300 hours. Okay, so labor rate variance, actual rate was $15.90, standard rate was 16, times the actual hours that we worked gave us a favorable labor rate variance of $32.50. For the labor efficiency, actual hours were 325. We should have used 300 hours times the standard rate gives us a $400 unfavorable variance. We went over by 25 hours. So the total variance is going to be $367.50 unfavorable. So if you took the 400 unfavorable plus the 32.50 favorable, this would give you a total unfavorable variance. Okay. So here they're doing it, calculating the three numbers. Total variance was $367.50. $32.50 favorable was the rate. The efficiency variance was unfavorable. Now I want to go back to this. What could have caused these two variances? That's what management is concerned about. You could have problems about that in your multiple choice. In the problems, all you're doing is calculating variances, but in the multiple choice, you might want to come up with reasons for the variances. So they may have paid them less because they used a different skilled worker. Their skill level was just a little bit less than what it should have been. However, because they were less skilled, they ended up using more hours. So was it a good decision to hire a less skilled worker than was specified? And the answer is no, because the total variance was unfavorable. So how do I take corrective action? I hire the skill level that's specified in the requirements by production. Okay. Now, what if I couldn't get skilled workers at the level I wanted? So I hired so that I would have employees keeping the assembly line going. Even though it ended up costing me more to produce the product, I at least continued the production process. So at this point, there is no corrective action that can be taken other than I will continue to try and hire more skilled workers in the future if they are available. So remember, sometimes there is nothing that the production department can do to make these variances better because of what is available supply-wise for both materials and your workers in the open market. Okay, so that would be an explanation. You might be asked in the multiple choice, what caused these two variances? So I want to look at journal entries associated with these variances. Your debiting work in process. Remember, we're carrying our product cost at standard. So standard hours allowed times the standard rate. We are debiting the efficiency variance because it is unfavorable. We are crediting a labor rate variance if it is favorable. We're making these assumptions here, and we credit wages payable for actual cost incurred. So that's the journal entry for putting variances on your books. You're debiting unfavorable variances and you're crediting favorable variances. Okay,